Today we'll be trying to understand reconstitution in one go. What happens is we tend to get confused in admission, retirement, where, what to do. We forget and we get confused. For that, this is a comparative study made for your reference. Before we do that, what are the areas we need to study? First thing is ratio, which is involved. Okay. So in change in ratio, someone gains, someone sacrifices. Whereas in admission, what happens is usually we find people sacrifice their share for new person. So we find sacrifice ratio. And the formula for that is SUN. SUN means sacrifice is equal to old minus new ratio. Then we come to the third one, which is retirement, where some person leaves, others gain his share. So here we try to find the gain part. And gain is opposite of sacrifice. G is equal to N minus O. And here we can use any one of the formulas. If we are using gaining ratio formula, answer is negative, it is sacrifice. If we are using sacrificing ratio formula, answer is negative, that means that person is gaining. So depending on these formulas, we will try and calculate the ratio. There are different possibilities for that. All typical cases we have tried to cover here, which you already know of. Like A and B are sharing in the ratio of 3:2. C admits for 1 by 5 share, find the new ratio. So 1 minus 1 by 5, 4 by 5, divide that in the ratio of 3:2. So that type of questions, or if in retirement we cancel that person's share, and in change in ratio, if the denominator is same, like in the first one, ABC sharing in the ratio of 3 is to 2 is to 5, change to 2 is to 3 is to 5, this is old, this is new. So obviously first one is sacrificing, second one is gaining, third one is sacrificing. So from here you can calculate this. Sometimes you'll have to put in formula, sometimes say in retirement we have 3 is to 2 is to 1. If B retires, new is 3 is to 1, gain is 3 is to 1. So we can be asked the formula of sacrifice gain, we can be asked to calculate new ratio also. So this is about the calculation of ratio parts. And then we come to the next part, goodwill. Goodwill treatment. Goodwill treatment, here we follow one rule in change in ratio. GS, gaining partners capital account debit, sacrificing partners amount credit. And the amount is goodwill of the firm into share or sacrifice made by them. In admission, if it is brought in cash, cash to premium for goodwill. And this premium goes to sacrificing partners capital account. And if not brought in cash, then new partners current account gets debited, sacrificing partners capital account gets credited. Obviously this entry is passed with new partner share of goodwill, and the ratio to be used in this is sacrificing ratio. In the time of retirement, we have follow the rule gaining partner debit, retiring partner credit. Gaining partner's debit, retiring partner gets credited. So that's the calculation at the time of retirement and accounting treatment of goodwill. But when it comes to accumulated profit loss, here it depends if we want to show the new value or not. If we want to show the new value in new books of the firm, we follow the rule, we give it to them in old ratio. But if we don't want to show, we follow the rule GS for accumulated profit, SG for accumulated loss. And then in case of admission, it goes to old partner, retirement it goes to old partner. Here A, B are there, C admits, so it goes to A and B. Here A, B, C are partners, say B retires, it goes to A, B, C, all the three. Clear? So next after that comes the next part of this topic is relating to the treatment of reval profit loss. Similar to what we have just studied, reval changes, you want to show the changes, then give it an old ratio. You don't want to show changes and you have reval gain, this is not accumulated but reval gain, then GS, reval loss, then SG rule is followed. Here again it goes to old partners. In this case A, B are there, C admits, so it goes to A and B. And in this case A, B, C are partners, say B retires, it goes to all the three A, B and C. This is the main thing which we need to know. Apart from this, one more thing which we need to know is adjustments. Adjustments are usually there in admission and retirement. A quick recap of these. In admission, case 1, new capital of firm is given. That say A, B, C are there and they are sharing equally, and C brings 10,000 as capital and total capital of new firm is 30,000. So each one's new capital turns out to be 10,000 in that case. We divide, either total new capital is given or C brings 10,000 for 1/3 share. So total capital becomes reciprocal 3 into total capital 30,000. Divide this in new ratio. Compare it to the old adjusted capital. If it is less, they will bring. If it is more, they will withdraw. Next comes the case where they bring proportionate capital. You are not given the share. They bring in proportionate capital. So when you find out adjusted capital, say adjusted capital of A is 20,000, B is 30,000. After doing all adjustment, these are their capitals. So adjusted capital is 50,000. Now let's see admit for 1/5 share. Take 1/5 of this. 50,000 is what? 4/5 of total capital. So when this is total capital, I'm taking it to other side. I take reciprocal of remaining share. So that turns out to be 5/4. And capital of new partner turns out to be 12,500, which is 5 got cancelled, 50,000 divided by 4. Sometimes they give it not as proportionate but percentage. Half of A and B's adjusted capital. So it becomes 25,000. 50% of A and B's capital, 30% of A and B's capital. So that's how you will be calculating it. In terms of retirement, when we do retirement of a partner, there can be cases where new partner's capital, new firm's capital, is given. A, B, C were there, B retire, new capital of firm is 50,000 and new ratio is 3:2. So 30 and 20 becomes their new capital. Compare it to the old one and transfer either the difference they bring in or it gets transferred to current account. In admission also it can be through current account also. Then comes next case where the here retiring partner is not paid, the amount gets transferred to loan account. In this case, what they say, they bring sufficient capital to pay the retiring partner. So we take adjusted capital of old partners, all three, A, B, C, minus available cash if any. Sometimes they have some cash with them, sometimes they don't want to touch that. And that will give you new capital. Divide that new capital in new ratio, difference they will bring in cash. Clear? Here they can give new capital same as old capital, what is given in the balance sheet, or other conditions could be given. Like old balance sheet of A, B, C, something was there, 60,000 was as capital, they want to continue the same. So there is a worksheet given on all 5 cases of retirement. You can refer to that. All 5 statements are covered over there. Basically, these 2-3 cases are their style of framing the questions may vary. Adjustment may be through cash or current account. So remember which case is asked. At least calculating the new capital, putting it as balance CD also gives us half mark for each posting. So don't ignore it. Thank you.